Hey, what's up? My name is Andres. Today we're going to talk about interest rates and possible implications of interest rate cuts on buying properties in a way that you can actually profit from it or make a loss. So this is a really key decision. Should you buy now when interest rates are high at around 5.5%, or should you wait for interest rates to drop and lock in a mortgage at a lower rate? And what are the implications right now when you lock in a high interest rate at 5.5% and the interest rates drop after that? Are you making a mistake? Should you have a short-term mortgage or should you fix your mortgage for the long term? Are there hybrid options that you can fix for some time, but then you can get out of it? All questions that are really relevant. And most importantly, you need to know the answer to these questions, because if you don't, you might make a deal that at the end will cause you to lose money or will cause you to have a lower ROI.
First of all, let's talk about interest rates. We've just had the decision through for the Bank of England on interest rates. They've done nothing, basically. Still at 5.25%. There was no cut in interest rates, but a cut is expected relatively soon. And you can see, actually, that's the path that markets think interest rates might go on in the future. This is the higher, obviously the line is the higher the interest rate. There's 5.25. Looks like it's kind of coming down in the future. That's just a market-based forecast. And you can see where it's come from in the past. That'll be relevant in a moment. Although everything stayed the same, 5.25%, you had the same kind of voting register on the MPC, the Monetary Policy Committee. So 7 people rather voted for a hold, 2 people voted for a cut. All of that stuff was the same. But some of the detail in the minutes was a bit different. There were a few hints that maybe some of the members are thinking about cutting rates quite soon. And look at what happened to the market bets on where interest rates were going to go. Like I said, this is the probability of a cut. So the higher this goes, the more the chance of a cut. And look at how that line went up. So the probability of a cut actually rose from around kind of 37% or so to over 60% once those minutes came through of a cut in August, so after the election, crucially.
So here's the standard model. When a lender decides to lend you money, they make an assessment of the rental income a given property can produce. Based on that rental income and the current interest rate, they will decide how much they can lend you on a property. So if a property yields £500 a month, they're not going to lend you £1 million. Okay, so you wonder, what is a stress test? A stress test has 2 scenarios. Either you own the property personally, or you own the property within a limited company. If you own the property personally, currently a lender will assume a mortgage interest rate of 7.1%. On top of that, they will layer on 40% for the stress test. So you can see it's a very hard hurdle to take. If you own the property within a limited company, it's the same 7.1% for the mortgage interest, but you only get an additional 25% to satisfy the stress test. So those are the 2 scenarios for stress tests these days. Of course, the big question now is, what do you do if you have a fantastic deal but the stress test fails? There are exactly 2 things you can do. Number 1, a stress test usually is mitigated or is less strict if you fix the interest rate for at least 5 years. They give you £100,000 if you have the interest rate fixed for 2 years, but if you fix it for 5 years, they might increase that to £120,000. So in that way, you can be a little bit more flexible simply by extending to a 5-year fixed rate. However, you need to keep in mind, currently, we are at a very high interest rate scenario. And just today, we had new data coming out that will probably push the Fed over the edge to start cutting interest rates. And then the Bank of England will have to follow suit. So by fixing your interest rate for 5 years, potentially you're making an error because you're paying the high rate. Whereas if you waited for a little bit, you might get a much better rate. The second way to create a little bit more flexibility on your lending ability is called top slicing. Top slicing means that you're not only considering the earning potential of the property that you're about to buy, but also your personal earning potential. So the lender will look at your current situation, how much your income is, how much you're spending, what your expenses are, and then they'll say, okay, this person has an excess income of, say, £300, £400, and they'll count that towards your mortgage borrowing ability. And so in that way, you can get a higher mortgage, while the property in itself doesn't really yield an amazing amount of monthly income. So the main problem that you have basically is if you lock in a 5-year fixed rate because you need flexibility in order to secure a deal, you will be locked in, and if interest rates drop, you have a bad deal. You're paying a lot of interest and you can't refinance because the break clause for the 5-year interest rate loan or 5-year fixed loan is really high. However, there's one lender that is really imaginative and did a great thing. They're called Virgin. What they do is they'll give you a 5-year fixed rate, but the break clause basically falls to the wayside after 2 years. That means after 2 years, you can refinance and you can get a lower interest rate should interest rates fall. And that's a really key thing to know, because that gives you a lot of flexibility and it opens up the doors to a lot of deals that previously were simply too expensive. So now let's go into the market using Dealsourcer with this as a backdrop and see whether we can find any properties that would make sense currently to lock in and to get the deal done, or whether it makes more sense to wait and speculate on interest rate cuts and wait a little bit longer, and when interest rates fall, and then you go and get a cheaper mortgage and you have more flexibility. Okay, so I'm on Dealsourcer's deal search right here. I already did a bit of a search. I'll tell you what I did. First, I selected the deal type buy to lets, then I sorted on RI, and then what I did on top of that, I required a minimum BME of 1%. Why did I do that? Because I want to buy overpriced properties that have a high ROI. I want to buy properties that are undervalued by a little bit or by a lot. I don't really care, but I don't want to buy properties that are selling for a price that is higher than the current value of the property. So I put that to 1%. So at least I know this is selling below market value. Then I cut out all leaseholds subject to contract, under offer, auction, public notices, and so on. So I get 33,000 deals. The second deal, I just went straight into it. So it's listed for 40K. We have a value estimate of 49, so it's 23% BMV. I like that because it means I'm buying for 80 cents on the pound. You have the local sold prices here. You have to go through those to make sure that our value estimate of 492 pounds per square meter is correct. Right, I then looked at the rent estimate of 507 pounds. For that, I went down to the local rents and I had a look around what other properties in proximity that are in similar condition and so on, what they're yielding. And I think 500 pounds seems reasonable. And that is, as you remember, what the lender will look at as well. The mortgage lender will look at will assess the property's ability to earn that rent. And yes, it might need a little refurb, but that's why I'm also buying it 23% below market value, okay? It doesn't look terrible. It doesn't look fantastic. Yeah, you'll need a refurb, but you don't need like a massive refurb, but you do need a refurb. So you're going to have to come up with a little bit of extra cash. But the thing that is so powerful about Dealsourcer is, now let's see what happens if we buy this in the worst possible scenario. Remember, the stress test is 7.1% plus 40% of stress test buffer. And that brings you basically up to an interest rate of 10%. Okay? So let's say we have to do a refurb, but we're not going to do a 30K refurb. Let's just say we do a 15K refurb, just roughly speaking. And so we have a total cash in of 26,770 with a 30K mortgage and 10,000 pound deposit and so on and so forth. The rent is at 534. Okay, it's about in that range that we think we can achieve. Now, I have put up the interest rate to 9.9% here already. It usually should be at 5.5%, which you can see is down here. And at 5.5%, your mortgage interest is 137.50 a month. If you go up to 9.9%, which is what the stress test will dictate, it's not 134, but it's 100, but it's 247.50, right? But at that value, we're still realizing an ROI of 7%. That means we're passing the stress test with flying colors, right? Even without doing any top slicing and so on and so forth. This property will pass the stress test. And remember, we're not paying 9.9. That is just the stress test. We're paying way down here, 5.5, right? And if you remember, if you lock that in for 5 years, they will lend you more than what they indicated, because they have more security that you're paying the mortgage and they know exactly the rate. So you could use that virgin offer to lock that in at 5.5%. And then in 2 years, when the interest rates drop, which they most likely will, in all likelihood, you can refinance that mortgage at maybe, I don't know, it could be that in a couple of years, the interest rates are at 4%. So then your ROI goes up to 14%. If you expect it to go all the way down to 3%, you make an ROI of 15%. So you can see how you can do your own stress test and your own deal analysis using the deal analyzer. And it's extremely powerful because it gives you a handle on how to translate that macroeconomic analysis into your micro analysis, which is actually the deal analysis, which is making sure that the deal pays you no matter what scenario is. You can get an ROI of 15%, especially if you use that virgin offer and lock in a 5-year interest rate, but then have the ability to get out of the deal and refinance or whatever you do after 2 years. So that's the power of Dealsourcer. I hope this was instructive. Just a quick example. Obviously, you have to do all your analysis and all your double checking yourself, but I think this is pretty instructive and it shows you the power of Dealsourcer. So as you can see, as a shrewd property investor, you not only need to be able to stack the deals and do the microeconomic analysis, but you also need to have an understanding of the macroeconomics. You need to have a very good understanding of the interest rate scenarios and the lending standards, because if you know what's going on in the lending market, you know what's going to happen in the future, you know your options, and you know what you need to do to secure the highest profit ROI deals. And not only that, but you also know how to protect your property portfolio or your property investments against adverse scenarios. And that is really the full tool set that an intelligent property investor needs available in order to make shrewd investment decisions. I think this is a very good example to show how powerful Dealsourcer as an application is, because it allows you to make amendments to the deal analysis and to factor in relevant stuff like changes in the interest rate environment or things like current stress test scenarios of mortgage lenders. So this is really, really powerful because it's not only fast, but it also allows you to do your own stress test, so to speak, to secure your downside. And in that way, you make sure you're not only protected, but you also secure the upside and you're paid for the money and the time that you're investing into your property portfolio. So if you like that live demonstration I just did, I urge you to go into the description and find the link to our 7-day free trial. Plus right now you're getting 20% off if you sign up today. And I think that's really a great starting point. Even if you just play around and cancel, and you can cancel anytime, it'll allow you to experiment and see what's really out there in the market. And you have to remember, you need to experience the market because the market is always right. You can't fight the market. So use the tool to figure out whether there's deals out there that make sense for you given the current interest rate and lending environment. My name is Andreas Reibel. I'm the co-founder of Dealsourcer. I hope you found this video instructive. If so, please hit like and subscribe, leave a comment below, and I'll talk to you next time.